And we hear it. We have confirmation. We have confirmation. So, look, always keen to start on time because I've got two wonderful guests with me today. And for me, it's super important because you've got a busy, busy day, and I really want to make sure we get things underway on time. So, as always, I've got a few housekeeping for you all. This session will run for about 45 to 50 minutes, leaving time to answer as many questions as we can from you all. The chat function is live, everyone. Okay, we want this to be as conversational as possible. Asked from our wonderful guest today, a wealth of information. So I want you to really get that conversation going. Today, we have a title of Maximising Sale Value and Servicing Smaller Clients. Now, I'm going to first of all just starting off with a little bit about who we are for those of you that don't know us. So, my name is Lewis Byford, the co-founder of the Financial Planning Club. And for us, we are a community specifically in the financial planning industry. There is two ways to get involved with us. The first one is actually joining as a club member. Now, as a club member, we are supporting owner managers of financial planning firms. And for us, it's about full bespoke one-to-one consultancy, leveraging the knowledge of our industry, providing you very clear 3-year business plans, breaking that down to a 12-month roadmap and holding you accountable every single quarter. And for us, it's about looking at your operational efficiency, how we can grow in the business, looking at your client retention, your marketing, and more importantly, coaching you to become the best businesses that you can. For us, it's about long-term value. And I've had the pleasure of having an accountability partner and a mentor for over 8 years now. And I honestly wouldn't be where I am without him, which is absolutely amazing. For me, and if you want to start thinking about your business, we have a lovely little scorecard, which is a fantastic tool to really measure and enhance your business and find out what areas you can actually improve on. So for me, it's really about thinking about your business in 4 core areas and thinking about what you can do to benefit and maximize your business as best as you can. For me, just forget about the noise that's going on out there. Think about your business. How can you grow your business? Break that down into small, easy to deal with chunks. And once you get that absolutely nailed down, you'll have a truly phenomenal business. And more importantly, we have our truly wonderful community. So we have now, it's actually sitting up to 1,500 members now, which I am absolutely astonished by, which is 5 core WhatsApp groups, which is totally free for everyone to join. And one of my team will probably drop the little link in the chat box if you want to get involved. But for us, it's about bringing community together. Nearly 600 power planners now in our community. It's a very isolated industry in some cases, and we want to bring that together. So whether you're a financial advisor, an ops director, admin or power planner, we can support you in our free communities, that peer-to-peer learning and membership. But we can't do what we do without our wonderful collaborators. Like we've got Julie and Martyn with us on here today. They really are the backbone of what we do. Yes, we see ourselves as a ship holding the fort, a wonderful team, but we need the knowledge, we need the background, we need that experience from our wonderful partners, and that's where they come in and add tremendous value. We've got everything from platform providers to operational overhauls, AI tech, you name it, we have it. And we're truly proud to have those as a part of us, which is a real honor. And finally, we have our next face-to-face event. So if you are an owner manager of a financial planning firm, we are back on the 8th of May, and I'm sure we have these two guests with us there, which would be absolutely fantastic. And for us, it's about bringing owner managers in a room where you can really get some peer-to-peer learning. Our goal for our members is to leave them as they did last time, feeling stimulated, energized, and enthusiastic about pushing the boundaries for their business. If you want to get involved, we'll basically put a little note in the chat. And if you want to drop us a little email, we'll certainly put you on the waiting list. And as soon as we've got that to go live, we'll send you the full agenda straight across. And our next webinar for those of you is the IHT Landscape webinar with another one of our partners, Way Trustees. That's on the 14th. So it's going to be Valentine's Day. It's going to be so romantic with me and the boys. It's going to be wonderful. But it's going to be a really great way for us talking about, a post-budget landscape. So it'll be a real good webinar to get involved with. But let's talk about our wonderful guest today. Today, we are joined by Julie. Julie is head of the advisor distribution at Octopus Money, a brand dedicated to making financial advice accessible to everybody. Julie works closely with financial advisors, helping them discover the best ways to support smaller clients and bridge the advice gap effectively. Outside of work, Julie is saving for a farm big enough to never say no to any dog that needs a forever home. And already, I believe you've got four, or is it five now? I can't remember how many you've got now.
Just four, Lewis, just four.
Just four. Well, I'm sure it won't be long. I'm sure it won't be long. And we're also joined by the wonderful Martyn, the partner at Catalyst. Martyn has a wide range of experience with financial services, mainly focusing on the financial planning sector. He built and sold his IFA business, Chartwell Investment Management, in early 2000s, and went on to hold senior positions in national and regional IFA financial planning firms, such as Chase de Vere and Gel Financial Planning. In addition, he started as an advisor back in 1986 and has continued to advise up until 2005. Martyn has got a broad experience across the advisory sector, has seen him involved in M&A for many years. His in-depth knowledge of advisory models allows him to negotiate and guide clients through sale process, avoiding many pitfalls and experiences. Well, what two wonderful bios from you both. I mean, I feel like I'm going to learn so much today. Thank you so much for joining us.
Delighted to be here. Thank you.
Absolute pleasure, Lou.
Honestly, it really is going to be good. So I suppose I'd like to really start off with maybe asking yourself a question, really, Martyn. What are the key trends you're seeing in the advice market currently from your perspective there?
Okay, well, first and foremost, thanks for the great introduction. I even like
Pleasure.
on that one. It was brilliant. Um, so if we break it down into, I think, to two key areas, look at the market and then look at from a firm level. From a marketplace, the stats, the number of firms, that's remained pretty consistent over the last like 5 years or so. Now, for a lot of business owners who might be on this call, I don't like the
Yeah,
word consistent or stable. You know, in business, you're either growing or you're going backwards. All right. So the
yeah,
number of firms have roughly stayed the same, as have the number of advisors, if depending where you look for the stats. And within there is a massive makeup that nearly 90% of all advisory firms in the UK range from 1 to 5 RI businesses.
right,
So
yeah,
it's a lot of small business, some really, really good ones out there. So we also have the average age of an advisor, I think is still about 57.
yeah,
Now, that does hide a lot of sins. To me, the most important factor isn't necessarily the age of the advisor, it's the age of the business owner. Because an agent advisor, that's fine. No disrespect to advisors, they're not going to dictate when that business owner wants to leave. So the age of the business owner, unfortunately, is around my age, 60 and north, and I think that's a worrying sign because many of those will be looking to exit. And the other trend we're seeing with the type of businesses we deal with is we're now servicing a smaller percentage of the UK investing population. So we've had a static number of companies, we have a roughly static number of advisors, but we're serving a smaller number of investors. And you kind of think, why? And just interesting, Money Marketing today put out a stat from a request of freedom information that the applications to go directly authorized by the regulators has gone down to 64% over the
wow,
last years, which is a bit worrying. From a firm level, Lee, what you have, and I have massive degree of sympathy for anybody who runs a business. You have regulation is the key trend we're picking up on every firm we speak to, and consumer duty is having a massive impact on that as well. So if you look at regulation, look at consumer duty, both of those are time thieves for somebody trying to run and grow a business, and it's piling more and more costs into your business as well. So we're seeing firms having to change their proposition, looking at ways of how do we serve lower value, lower ticket clients, which is, I think, almost a conversation we're having on a daily basis. And all of that feeds into, and the word you're going to hear a lot today is data. Data. And I never realized at my age I would be so excited about data, but I really do get excited about data. And as a business, you should, because data is actually gold. Within your business, the quicker and more accurate data you have, the greater your value is going to be. So the trends are flatlining in business numbers, flatlining in number of advisors with business owners getting older, firms really under a lot of pressure due to time and data requests, and a lot of older business owners, such as myself, who will be looking to exit over the next 5 years.
Yeah, absolutely. And that's going to have a natural play in mergers and
Yeah.
acquisitions. So, from your experience, what do you see in that world then? How does that relate back?
Yeah, no, that's a good question. So mergers and acquisitions is a common part of any industry, any business. It goes on all the time and it shapes businesses. You only look at the car industry, you look at VW.
Yeah,
It's a group now. How many businesses how many different brands sit under that? And our industry is no different. It will shape the industry going forward. Um, Volume deals are slightly lower at the moment, and I think part of that is the impact of consumer duty and the regulator going, you can't just buy businesses anymore. You've got to have a proper plan to integrate them as well.
yeah,
So volumes are down slightly, but we have had a couple of, buy now while stocks last events. We had the budget,
yeah,
and so lots of people were trying to get deals done prior to the budget. And I have to give the regulator a pat on the back here because their changing control process was brilliant on the run up to the budget. They were really, really helpful, which are, we criticize the regulator, but they were really, really good. And we have another buy now while stocks last, which is the end of this financial year. So
right,
that's
yeah,
created a couple of, I would say, false peaks on where we are. So overall volume deals are slightly down, and actually prices likewise are down slightly as well. And I think part of this is firms are now just having to take a step back and look what they do. They have to put plans for better integration. Integration is absolutely critical now. You can't just go out and buy. You've got to go out and buy and then look to integrate. And almost the integration bit is possibly more important than the acquisition. The two now are really, really combined. And that slows the process down a bit, Lee, as well. And I think that we are in a market which is still going to be very, very active over the next 3 to 5 years. IFAs are still very, very attractive businesses. So whether you're looking to buy or sell, there is still a lot of demand within the marketplace for good quality financial planning practices.
yeah. But I think we're also seeing that from our side as well. Like if I look at the club members, you know, we're getting people coming to look, I don't want to sell to a consolidator. I don't want to sell to that. I want an alternate option now. They've seen it go bad in a way, and they want something a little bit different, which is quite nice.
Yeah, it's interesting. I have a view that there is space in this marketplace for lots of different models. And I
Mm.
think some consolidators, and possibly quite rightly, Lee, have got a bad rep
Yeah.
because they haven't done it right and they haven't paid focus to the client. But I do think that, just because you're a consolidator doesn't necessarily mean you're bad.
Yeah, absolutely. No, that's very, very true. So what other options are there available to those considering selling their advice business?
Right. So for people on the call and your clients, to me, the most important thing is plan this well in advance.
Yeah.
So we'll have a lot of clients we deal with. I'm looking to sell my business now and I want to be out within 3 years. Well, you've limited your options straight away. So you could look at employee ownership trusts, you could look
Yeah.
at management buyouts, but both of those, you're going to need to be planning this 10 years before you actually do it. Okay, not 2 or 3 years. So you need to make sure you're giving yourself plenty of time. If you haven't had the luxury of that planning for time, you're looking at whether you do a share purchase, a share
Yeah.
sale, okay, which is basically as a limited company, you sell your shares, which helps you limit the liability that you built up within your business, once you've sold it. You've got asset purchase where the clients, the assets will be bought from within your business. You've got full or partial sales, which are quite interesting at the moment. That there are a few more firms doing that. So you've got plenty of options. But to me, if anybody can take one message away from what I'm saying right now, plan it well in advance. Give
Yeah.
yourself the luxury of time, and you can look at different options.
And who are actually acquiring these firms? What are their driving factors that you're seeing from your experience?
So if we're really blunt, Okay, the driving factor for anybody who's buying a business, whether you're, people sitting here today, whether you're looking to buy a smaller IFA, you're looking to make more profit. Okay, so profit is not a dirty word. Anybody who buys a business is looking to make more profit. I think the difference comes in how you make that profit and the time scale you're looking to make that profit.
Yeah.
So there are plenty of large acquirers, they're quilters and people like that. What we've vertically integrated firms where they make margins on the advice fee, they make margins on the platforms, and they make margins on the funds. Okay, so those people are looking to buy businesses that fit in their model, and they can look at how they can increase the margins all down the value chain.
Yeah.
You look at other firms and you look at some of the very large IFAs. Most of those firms will make their money purely on the advice fee.
Yeah.
What they're looking to do, they're looking to grow. They're looking to increase the number of advisors. They're looking to buy what they would consider good quality firms to bring into their business and to continue to grow and expand their footprint in the UK. The bit people get really nervous about is who is funding the acquisition. Right. You say private equity, and a lot of people go, oh, that's a dirty word, because private equity, they want to come in 3 to 4 years, they want to go out having taken all the profits. Without private equity, we wouldn't have many of the large firms we have in the UK at the moment. Private equity isn't necessarily a bad thing. Private equity helps starter firms get off the ground and go on to bigger and greater things. So I think the key thing to look at if you are looking to sell your business is look at the funding that sits behind that business and how quickly they're looking to go from A to B. Okay.
Love that.
I think if you, Lee, at the moment, people are pretty sensible. Private equity will like to get to a certain level and then they'll refinance. Doesn't mean the business has to change at all. It's like going from bank A to bank B, right? The proposition stays the same. Your service to the client gets the same. It's how it's funded.
Love that. Love that. So a big thing we talk about for our club members is thinking about that retirement. It's actually thinking about how you get ready for a sale. Okay. So what are the key things that the acquirers are looking for and how you can get ready for that sale?
Right. And there's a real commonality, what they're looking for and what hopefully you have and how you run a good business. Ultimately, acquirers want sort of a unicorn. They would want the perfect business. They would want average client size of 500,000 to 1 million, no DBs. Everything's perfect. Your charging structure is aligned to theirs. It doesn't exist. Okay. What an acquirer is looking for is a business who is culturally, and I would say propositionally, as closely aligned to their current business model. And Consumer Duty has really highlighted the proposition aspect around charging structures. So that's number one. How close are you to their existing model? And then you start dipping down into that. Okay, do you have DB in your back book? Fine. And there's nothing wrong if you do have at all. It's how well managed is it? Is it fully insured? Are the clients getting annual reviews? What type of review are you doing? Are you looking to, should you be going to an annuity every year? What type of process are you giving to a sector of your book which is deemed to be high risk? Have you done your annual reviews? This is the new DB issue. If you haven't done your annual reviews, you do have an issue. But if you've got time to put it right, if you're looking to do 3, 4, 5 years down the line, what are you doing to put that right? Are you going back to clients and so on? Clients, and I know we're going to touch on this a bit later about the size of clients. They don't want small clients in the main, all right? They want clients that they can make a profit on serving those clients. So good cultural fit, and all backed up. I'm going to say again, good data. Can you prove you are as good as you say you are? And the way of doing that is having good quality data. So when you're preparing to sell then from the vendor, the business owner, I would say the number one thing you need to do is sit down over a weekend with a bottle of wine and go, right, when do I want to, and also what's my price? What do I need from the sale of my business? And once you've got that in your head, it's then, okay, number one, is my business worth that much? So you need to go out and find out if I need 4 million from the sale of my business. If my business is only worth 400,000 today, I'm not going to be able to retire. I'm going to have to retire on a very different price. So that's the first port of call. When and what is your price? And then you look at, now I've got that button down, what do I want for my clients? What are the red lines I will not cross over in a deal
Yeah.
with my clients? And the same for your people. Okay, it's always really, really good when I speak to a business owner and they go, right, priority number one, clients, priority number two, people, priority number three, me. And
Yeah.
you've got a great business, right?
Yeah.
And you know that you can sell them, and you know an acquirer will love them because they've got it all ranked in the right area. Because if it works for your clients, it will work for your people as well, because your people like happy clients, your advisors like happy clients, clients stay, means your advisors and your staff are happy. And then if it works like that, your business owner is going to be happy because the profits keep coming in as well. Okay. So understand what your price is, when you want to go, and then understand and write out, I won't accept this on a deal. These are the lines I will not cross over when I'm doing a deal. And then you can sense check that against the marketplace to see how doable that is. So, for example, if it's your business, you're going, I want 4 million, but I don't want the proposition to change. I don't want the charging structure for my clients to change. I don't want anything for my staff to change. You're never going to sell your business.
No,
All right.
exactly. Yeah.
There's a compromise in there. So it's just sense checking that compromise.
Yeah, love that. Love that. I'm going to talk to ask you a question around valuations. Okay, this is a when I saw this question, I thought, oh, this one I want to know more about this one. What are the biggest challenges when it comes down to valuations? We keep hearing in the market, yep, 3 times an average, 4, 5, but how are you getting up to that higher level? What are the big challenges around the valuations? Tell us little bit about that.
So it's your business model. Okay.
Yeah.
So you can talk about, you can get 3 times ongoing revenue. So businesses are often sold on a multiple of either ongoing revenue
Yeah.
or EBITDA, okay,
Yeah.
which is the margin of profit. And it's a multiple of one or two of those. Now, if you do a valuation on your business and you do it on ongoing revenue and then you do it on EBITDA, and the two are in a very similar position, you're in a quite a good place. Okay.
Right. Okay. Yeah.
So again, to get an indication, you've got to have good data. It's the same thing. You've got to have good data. So if your clients are all 85 years old plus, the value you're going to get is a lot less. Because people don't want people who may not be here for that long. If all your clients are 45-year-old, you could get more for your business. There's so many different aspects that will come into affect it. So what you have to be able to do is be able to have almost like a document, a front that says, this is who we are. This is our client makeup. This is how profitable our clients are. This is how we remunerate our advisors. When you look through your business, this is how we manage risk.
Mm-hmm.
Okay. Everything that says, if you were looking to buy your business, what would you think that's good and what would you say that's bad?
Yeah.
Right.
Yeah.
And then once you've got that, an acquirer the quicker you can provide data, and we always take this as quite a key point. If we ask for data off a business and they can let us have that within 24 hours, big tick in the box.
Yeah. Okay.
Have
Yeah.
management accounts. Yeah, here we go. Bam, and you've got them while you're on the call. Brilliant.
Yeah.
If it takes 4 weeks to give you this data, it's a problem.
Yeah.
Okay, and the acquirer will also look at you in the same way as well. So getting the challenge in the business valuation is, I've got 100 clients. This is my ongoing revenue. Well, okay, out your 100 clients, can I have the split of the ages? Can I understand the assets that are attached to the clients of those ages? Can I understand the revenue that's attached to those assets of those ages? You've got to better give really good client detail. Okay. And I think if you're trying to show how good you are as a business, make sure you keep a note of things like referrals.
Yeah. Yeah.
So if you've got organic growth and it's all from referrals, that's a really good indication as to the quality of your business.
Absolutely.
Client testimonials. All right. So I could sit down and talk to 5 businesses, all with very similar backgrounds and output. So if you're all vying for the one buyer, what's going to make your firm look much better than the other 4 that you're competing against? Okay. And it's all the other little things that say you are special and you are worth paying more for because of all of these other bits as well.
Absolutely. Just want to just briefly touch back onto that valuation piece there. So for firms that have got a vertically integrated model against an IFA firm that's just looking for, that's just earning the money off the advice fee, would you get paid more if it's a vertically integrated model?
Yeah, so that's a really good question. And we would expect to get our clients more for a vertically integrated business.
Okay.
Because you look at, right, we're making X amount on ongoing fees
Yeah.
and business, but we will negotiate hard for our client because we're saying, well, actually, if these are going to be moved onto your platform where you're getting so many basis points, we want our clients to share in
We want to
those.
cut off that. Yeah,
Yeah,
absolutely.
correct.
Yeah,
So that's
absolutely.
our job. But again, put the client at the center of that, Lee, because if you're going to move them onto a platform, it's costs more. It's not going to happen. Yeah.
Exactly.
Okay.
Yeah.
So what we would expect is for vertically integrated firms for us to be able to negotiate. Part of the deal would be to how many assets are moved onto a platform if it's suitable for the client. That's the key bit, if it's suitable for the client. But we would expect them all the time to share some of that upside with our clients.
Yeah. Okay. Amazing. Amazing.
Good question.
Julie. Oh, yeah. No, absolutely. I thought I'd briefly mention it. I know, it comes to the top of my head. Julie, obviously, mine's touched on obviously the advice landscape.
Yeah.
So, what does that mean for the advice gap? The big question that
Yeah,
we all talk about, the advice gap. What does that
I
mean for it?
know. Yeah, it's so difficult, isn't it? Because I've probably spoken to about 120 firms over the last 6 months about exactly
Wow.
this problem. So essentially, there's only 8%, 9% of people accessing and paying for financial advice in the UK. And the difficulty we have is that partly due to consumer duty, the cost of delivering regulated advice has gone up.
Yeah.
And it puts the advisors that I'm speaking to in a really difficult position because they've maybe worked out that cost to serve. So, how much does it cost me to deliver regulated advice? So, the initial advice and then the ongoing advice. And that's not just delivering the annual review, of course, that's the whole, they need comfort with the questions on the budget or something's happening in their life and that ongoing engagement. And that number varies enormously. And also, some firms haven't really actually nailed it down. But typically, the cost of delivering it is going up. And that means that there's two challenges. One, some people aren't going to be able to access the financial advisor.
Yeah.
So, Octopus Money did some research after Consumer Duty anniversary, and new clients aren't being onboarded typically unless they've got over 214,000. So, that
Right.
locks a lot of people out of the advisor market. And then the existing challenge is if you're already being advised, lots of advisors are then saying, look, sadly, you're no longer commercially viable to serve. So any clients below maybe £200,000, actually, when you look at the fee that they're generating, the cost of delivering the service, so the advisor time, the admin time, the para planner time, it doesn't add up. And they're in this really difficult position because advisors by nature are saying, how do I help?
Yeah.
But commercially, they're saying, actually, hang on a minute, I've only got 8, 10 hours in a day. I need to use this to get the biggest bang for my buck and deliver the best value for clients. But you can't, the one thing we can't make more of is time. So advisors in a really difficult position. So I think it was a Lancat that said there was a stat that 55% of advisors are now starting to disengage clients. And certainly the firms I'm speaking
We're
to are
seeing
having
that.
that,
Yeah.
yeah, that
We
dilemma.
are
And
seeing it.
it's a horrible feeling because the options are, well, if you've only got so many hours in a day with consumer duty, you have to evidence the delivery of ongoing advice. Do you take on more advisors, in which case you then have to kind of grow your infrastructure, your compliance, your QA, your performance excellence team, and everything else? And then, of course, the people that are outside of that who are looking for advice, obviously, as we talked about, the kind of demand is
Yeah.
growing, the supply is fixed and aging. And we now need to try and look at different ways for those people that need help and advice, but sadly don't have the 214,000.
Yeah.
So yeah, a very tricky one, I'd say.
Absolutely. And a really valid point that you touch on because I talk about it so much in every single advice firm that I speak to is about do they actually understand the cost to give advice? And I can honestly say 90% of the firms that I speak to have no idea what their costs are to deliver that advice. I said, how much is your admin? How much is your power plan? You're outsourcing that cost, aren't you? Or what is the cost of you doing that? What is the cost of you to deliver on that? And when we actually sit down and break that down and ask them to come back to us, evaluate that cost, one advisor just by doing that came on board with us, actually increased his fees just by a handful of small clients that he had by over £15,500. And his clients were like, oh yeah, no problem at all. No problem. £15,500 additional cost plus by understanding this is my cost of sale, and it's super important that you do that. So for any key takeaways, make sure you know what your costs to deliver are, so
Yeah.
important. So good that
Yeah,
you
and be realistic about it. So as I say, it's not just annual
absolutely,
review,
yeah,
it's all of the ongoing touch points, sending out the
of course it is.
newsletter, updating their admin, all of those kind of
Yeah.
things are important. So I think getting the cost to serve is right. And I think the dilemma for Consumer Duty for advice firms is when you get to a certain level of assets,
Yeah.
if you put in place a minimum fee, there comes a point where you fail
How
the
can you
fair value
justify?
test.
Yeah,
Because you're like,
that's it.
actually, you've only got 30 grand. There's no way I can charge you this fee because you were just eroding your pot. So when
Yeah.
it comes to kind of articulating value, the fair value test, actually, that's where there comes a pinch point where you say, actually, it's not the right solution for the clients because we're eroding your pot. It's not the right solution for me as an advisor because actually this is costing me a lot of money to look after. There
Yeah.
has to be a better way.
100%, 100%. Going over to yourself then, Martyn, then. So how do lower asset value clients impact your business valuation? So is that a positive, negative effect? How does that impact?
Right. So we've got a little case study here. Not a
Oh,
case study. This is a live case, Lee, we have at the
right.
moment to try to bring it to life for your clients who are on this today. And what we have here is, as you can see there, 588 clients, 135 million under management, about 1.2 million of ongoing advice fee. When we played this back to the client, we looked at it and we said, do you realize that 50% of your clients only account for 14.3% of your fees?
Wow.
And it was like, well, what do you mean? Well, and we just showed him these figures. So you've got 290, was it 290 clients that your cost to serve, you don't know what that is, because the average case size on this is about £600. It's
Mm,
costing him more to service. And the way we presented him to the business then, his average case size was about 230, 240K. He's making a loss on those smaller clients. Now, some of those smaller clients, if they're kids attached to mum and dad, that's fine. But the majority of them weren't. So what would have been good, and we didn't have the time to do this, unfortunately, because he wanted to retire now, we would have either, you could do two things, and I'm sure
mhm.
Julie will articulate one of these options. Either you're going to have to create a new service for these clients where you're not making a loss on your cost to serve, or you're going to need to go and find another solution
Yeah.
because at the moment you're making a loss. Now, from an acquirer's point of view, they're looking at this and going, well, if that average case size there is £600 and it's costing us £750 to service a client, what you're saying is we're buying 290 clients and we're making a loss on them every year. So they don't want them.
Mm,
So the fact they don't want them, they just want to turn off the ongoing fees because it's a risk. It's a risk to them. They cannot deliver a service for that level. So that will then naturally depress the price that the client is going to get for his business. If we'd had this client 2 years out, we could have done one of the two options, either created a new service or found a second solution to have done that. We could have then gone to market and presented this business in a way that the average case size was then about 440,000.
right.
You imagine you're now doing 50% less service reviews every year. Now,
Profits going up straight away, isn't it?
so
Ugh.
you can deploy the people within your business now to either provide a better service, to find new clients, to new services that you provide something really rich for your existing clients, or yeah, and that's the way most firms would want to go rather than laying people off. But if you've got people who are looking to retire, you don't necessarily have to replace them. But if we could have got this firm further out, we could have done something for the lower ticket clients and we could have taken him to market showing his average case holding for his client was just under 500,000. It would have been a much, much easier business to sell and we would have got him a high price for it. Consumer Duty has just highlighted this. It's not 2-3 years ago, Lee, people would have go, yeah, we'll buy it, but we'll pay you a bit less for it. Acquirers again, we don't want it. It's a risk to us. So we don't want it at all. So there's no value to it whatsoever. And in fact, it's a blocker to your business if you're looking to sell.
Yeah, absolutely. And so Jude, if I come back to you on that, how do Octopus view that? What's your view on that side?
Yeah, I mean, we feel very badly for advice firms and also for clients, but essentially, our business, our mission is so we're a B Corp, so what that means for people that aren't familiar, it's like a fair trade coffee stamp for businesses, but essentially means we balance the needs of people and the planet alongside profit. So looking at all the different stakeholders, including community. And we know that obviously advice and people's financial resilience, it's a societal issue, so we need to tackle it. So within Octopus Money, that's, I guess, what gets us out of bed every morning, is making sure people get access to help and advice. We are blessed, I guess, in the fact that we are a privately owned business, and we're able to kind of take a longer term view on customer lifetime value. So essentially what we have done within Octopus is we have kind of ripped up the regulatory model and said, look, what we've seen working brilliantly with advice firms is that holistic advice. We need to find a way of doing that that is manageable for the mass market. So we have taken a non-regulated function, so a financial coach. We've teamed that with technology that delivers regulated advice, and that allows us to deliver a really great customer proposition at a fraction of the cost. So those financial coaches, we take about 3% of the people that come to us, but essentially they are skilled in empathy, rapport. Talking about money is such a taboo subject, and you don't want to appear daft. You don't want it to be an intimidating journey. You want it to be empowering, positive, and for people to feel that they can talk about their hopes and dreams, talk about, everything from protection, mortgages, doing their will, power of attorney, pensions, everything. But you need that human, the best of humanity. But then the technology allows us to deliver that through algorithms. But it means that we can do that at scale. So we're not constrained by advisor capacity. We've got the tech delivering the advice, the humans delivering the engagement, holding the hand, and it means that we can deliver that at a fraction of the cost, which hopefully will mean it's accessible to more people. And I guess, what we're really passionate about is working with advice firms to say, we can help you. So for the smaller firms that are saying, look, people come to me every day and say, I've got 50 grand, can you help me? God, I'd love to help them, but you just can't. Advice firms can refer clients over to us. We pay for those referrals. Every client gets a cash flow model refreshed every year. They get 3 or 4 sessions with a financial coach. They get a financial plan built. They get access to advice. And so we can, I guess, make sure they never have to say, I'm sorry, we can't help you. They can say, well, actually, I know someone that can help you, and we pay for those. And then we also acquire client banks. So we work with advice firms to say, as Martyn showed in that example, all of those clients where they are loss making for the firm, they're possibly not getting, the resource that they would need. We can acquire those clients, move them into Octopus Money, which frees up, it's the opportunity cost point. Actually, all of those hours freed up, you can then spend on clients that have more complex needs, higher levels of wealth. So it's a win-win situation. And then we're working with our large partners. So banks, building societies, really large wealth managers, those vertically integrated firms, and we're putting our methodology inside their business so they can reduce the cost to serve but contain the client ownership, and they never have to turn the client away. Their growth isn't constrained by advisor capacity, and it's a lovely mechanism where they can incubate clients, while they're maybe the children or grandchildren of their wealthy clients, incubate them, and then of course that's probably the clients of their future. So I guess we're trying to do things in a slightly different way, but support the advice market, so we can do this hand in hand. So hopefully we can complement the amazing work that the advice market does currently. We can just afford to do it for people that have lower assets, because we're able to use a financial coach and the tech.
So Julie, just on that example, what options would Octopus offer that client that we've just gone through?
Yeah, so again, from an advice firm point of view, it is that paying for referrals. So we direct people to us and we pay for them, the selling of the client bank. And as I say, for large firms, and by large, I probably mean 2 billion and above, we will put the methodology inside their business. For the clients, what they get hopefully is a model that's really appropriate for them. So people that have simpler needs, where it is, financial coaching. So again, having regular sessions with a coach. And the difference is, because you're having maybe 3 or 4 sessions with a coach every year, it's those nudges. So yes, we have an advice gap, but we also have an engagement gap, an accountability gap, where you're actually having someone saying, actually, you're meant to, you promised me you'd top up your protection, you promised you would do your will, or actually you are going to match your employer pension contribution. Having someone giving you those regular nudges can really mean that from a client proposition point of view, they get something that's really valuable. And the cash flow model really clearly articulates the difference between, if clients do nothing differently today, they might end up with a pot of, I don't know, say 1 million. But if they take all of the actions that the regulated advice is telling them they should do, so start investing, maximize their pension contributions and so on, create an emergency cash fund, the difference in the client outcome can be absolutely staggering. But I think the point is, the tech and the coaches helps clients make smarter choices, because that's all money does. It just gives you choices. So once you're really clear about where you are, where you want to be, the combination of the tech and the coach helps people just, I guess, achieve their dreams. That's what we hope.
Love that. Love that. I've got 2 polls here that I think maybe we should launch. I've got here, is your business sale ready? So for those people that are listening, if I launch that, it'd be quite interesting to see what people think on that one. We're getting them coming through thick and fast, which is quite nice. And while we're leaving that up for the moment, what if I go back to you, Julie, on that question, really, is what can clients expect from that?
From working with us? Well, hopefully,
from working with you, yeah.
Yeah. So clients themselves, hopefully it's that engagement piece. So as I say, when clients work with us, they can book in. So lots of things are done digitally. So the start of the journey is what we call an EQ. So it's like an online fact find, but not a fact find that we might be familiar with. It's more, how do you feel about money? Does it make you feel anxious? Does it make you feel excited? What are your goals? Are you on track? And all of that starts to be populated, the fact finding and the cash flow forecast that the customers will run through with their coach. That regular engagement, the touch points, we've got lots of educational content. The clients can log into webinars, they can read articles, and again, we're here. And then from a digital advice point of view, that cash flow model is refreshed every year, hand in hand with the coach. Any changes in your life, so maybe you've got promoted, maybe you've got divorced, maybe you've inherited money, maybe you're deciding you want to retire early, that regular engagement will make sure that the advice is always up to date. So I think it's the blend of a hand to hold, and also, I guess, visually, what we see is that the tool is super helpful for people because it brings it to life visually, the impact of making those choices. So clients can log on to their portal, create as many different scenarios of their financial life as they like, and the cash flow model brings that to life. So the implications of retiring early might be you retire on a lower annual income, but at least again it allows you to make those choices.
Absolutely.
So on that's what clients can expect, Julie, from a business owner's point of view. And we talked about, you can sell off a client base. What else would it do you think, for a business owner, by passing over
by selling clients? Yeah. So from a when you sell the clients over to us, it's really about releasing that capacity. So we have lots of firms that they do it 2 ways. So one, their driver is shrink to grow. So actually, do you know what? I have got growth ambitions. I really want to move my business forward, but I've only got so many hours in a day. I don't really want to recruit more advisors, because actually it's all the infrastructure that comes with it. So by freeing up that advisor, admin, paraplanner capacity, they can focus. You lose a Susan and her 50 grand, and you can then focus on, Tom and his 500,000. If businesses are thinking about selling, then, as you say, by, I guess, essentially rehoming, finding a trusted home for those clients that are lower asset value, they can then increase the average AUM and attract a higher multiple on a higher average AUM. So I guess it's smarter choices for both, smarter choices for advice firms, where you get a bigger bang for your buck on your time and your resources, and smarter choices for your clients, where they get appropriate help at a reasonable cost.
As we've had conversations before, and I don't think this hasn't hit a lot of people, it's the de-risking of your business. So if you look at people like SJP having to put aside, was it 435 million, Quilter's having to put money aside. Now, I know the regulator has gone after the big people, and eventually this will filter down. So it's not just a matter of revenue, it is a matter of de-risking your business. And that will I think that is a key factor that people aren't necessarily picking up at the moment, in as much as it's not an option. You do have to do something.
Totally agree. I'm going to share them results now, and 100% of people need to do more. Absolutely need to do more. So that was quite interesting. And while we do the final poll here, I've just got a couple of questions just again for you. So answer that question. What proportion of your AUM do your clients have less than 250k make up? So have a little run through of that one while I talk through just some other questions for you. One's coming around, probably aimed towards yourself, maybe Martyn. Are you seeing a shift from valuations based on AUM to EBITDA from your experience?
So it's a really interesting question, because every firm will value the acquirer will value the business based on EBITDA, because you're buying a business for profit. They express it often, though, as a multiple of ongoing revenue to make it often easier for the vendor to get their head around and to understand.
Yeah.
So like I said, all acquirers, they'll buy it on profit. They will express it as ongoing. The bigger you get, the more it is focused on EBITDA. If you're a single RI business with 50 million under management, you can control your profit, because it's you the main cost, and so that will generally be expressed as a multiple of ongoing revenue. If you're a 5 RI business, you've got an infrastructure. They want to know more about the profit rather than necessarily ongoing revenue. So I would say, as a rule of thumb, if you're a small business, it's often a multiple of ongoing revenue. If you're a larger business, it's EBITDA backed up by if we were to do this as a multiple of ongoing revenue, do the two marry up with each other?
Absolutely. And I think, even yesterday, I'll end that poll there and I'll share the results for you all. 36% under 20 and under 20% are saying that, and then another 40% over. So, quite interesting stats are on the clients' AUM there. We're seeing it ourselves. Even a conversation I had yesterday with a business, 80 million funds under management, absolutely at capacity. He's got 120 clients. He was like, I can't push my business forward. I'm just too busy. I need to think about what that solution looks like. First thing I've asked him is, what is your cost? He hasn't done that yet. I said, that's the first thing I want you to be doing. Understand what that looks like. And then next conversation is going to be what you're going to do with that. Why don't we look at some options and kind of think about maybe selling that off, because that's going to give him the cash, the capital to grow back into the business at the same time. And I think that's what people aren't realizing. I think they want to just bring on new clients, but you need to bring on the right clients. And a lot of the time they haven't thought about, who is my right client? Who is my ideal client? And sitting down and understanding that first of all, and understanding your cost base really does transform your business and gives you more value, doesn't it?
Yeah, I mean, you've hit a big thing there, Lee, which is about time. And I have huge sympathy for business owners. They run out of time. And the one thing I've seen where you've had a 2 or 3 RI business who's looking to grow, without fail, 100% guarantee this, the best thing they've ever done was to recruit an ops director, not another advisor.
Yeah.
They recruited an ops director, and that has every business I've come across that has transformed their business to growth. So if you're looking to grow, it may not be an extra advisor you need. All right, look for a different way of doing it. And you provide consulting services, and I'm sure you're looking at things. You've got an ops director. It frees up your time. They transform the business. I've come across a business where it's had an ops director that hasn't taken the business on to the next level.
Absolutely. Couldn't agree more. Well, look, thank you both. Just thought to kind of really summarize, I suppose, would be quite nice. So, Martyn, for you, what should firms do if they're thinking about their exit strategy? Tell us a little bit about that.
Yeah, I would just say the best thing to do is give yourself plenty of time. If you're younger and you think, I've got 10 years out or 5 years out, start to plan it. And as your survey said, getting a business ready for sale doesn't mean you've got to sell it. All it means is you've got a business that's running brilliantly well. All right. And then you can choose when to sell it, but make those plans, give yourself time. And you should run a business as if you want to sell it tomorrow.
100%.
All right. So you provide all the information, everything's up to the speed, everything's done. So if you run your business like that, you don't have an issue. But as a business owner, just make your plan. All right. Don't leave it to the last minute. As you would advise a client to retire, all right, do the same with your business. It's exactly the same process.
Yeah, absolutely. Absolutely love that. And Julie, what would you say are your top tips for advice firms listening today? Oh, I like that question. That's quite a good question, isn't it? Top tip. I love a top tip.
Top tips. I would say know your cost to serve. So if you don't know it, get help. And obviously, Lewis, you and the team can help with that challenge. The other thing I would think about is also, are there any conflicts in your business? So quite often when I'm speaking with advice firms, the challenge they have is their advisors are paid on assets or revenue. And if you're asking an advisor to disengage a client or rehome a client to a trusted home, the advisor saying, why would I do that? Because that's part of my target or part of my remuneration. So if you're planning to do a business transition where you've under consumer duty should have identified your target client and you're asking advisors to behave differently. So we're saying, actually, now we're not going to pay you on those clients that are loss making because we want you to hunt more of these. Just make sure that the way that you're remunerating those advisors is in line with that strategy, because quite often that's where we find a little bit of a conflict. So that's some of the scars that I've earned over the last 6 months.
Love that. Love that. Love that. Love that. Well, look, thank you both so much. It's been a wealth of knowledge with both of you. And look, if you want to get in touch with either of them, the details are on here today. Obviously, this has been recorded. So for those people that can't join us, we'll be sending their contact details over and an email everyone that's registered as well today. And if you've got any final questions, please don't hesitate to ask us in the Q&A and in the chat function. But, from me, from my side, both, thank you so much. It's been an absolute pleasure. And I've got so many more questions to take offline. It is insane. So really, really great. Really, really great.
Thank you for having us.
Thanks, Lee. Thank you.
Take care.
Pleasure.
Bye.
Bye-bye.